So lower of cost or net realizable value. The first thing we have to figure out if we're going to apply this lower of cost or net realizable value rule is what is net realizable value. Okay, so if we look at it, you start with the selling price of your unit of inventory. You deduct the estimated cost to complete that inventory, dispose, and transport it out. And that gives you your net realizable value. These disposal and transportation costs are often referred to as selling costs. Okay, it takes a while to get through this chapter because they use different terms and it takes a while to sort them all out. So I've already done some of that. Okay, so what does this look like? If you wanted to get to the net realizable value, here's your unfinished inventory cost of 400. Here's your selling price of 450. You've got cost to complete of 10 and selling costs of 20. And these are for two different scenarios. So in the first scenario, you start with your selling cost, your estimated selling cost of 450, less your costs to complete, less your costs, your selling costs, the disposal and transport, and that gets you down to your net realizable value. Okay, so if you were going to compare, if you were going to do lower of cost or net realizable value, you'd say, well, our inventory cost 400, it is valued, the net realizable value is 420. It's always nice to find these typos right now. Great, this should be 400. Just forget you never saw that, okay? So if you're going for the lower of cost and net realizable value, it would be 400 because 400 is lower than 420. Okay, now in the other situation, if you had slightly higher disposal costs, your selling costs and everything, you would start with your selling price, less your costs of to complete, your disposal costs, and you get to a net realizable value of 390. In that case, you would compare the 390 to the 400, and you would choose the 390. Okay, just cover this piece right up. Okay, so that's where you start with the what is the net realizable value. It's basically your selling price less your estimated cost to complete the inventory, dispose, and transport it out, your selling costs. Okay, so what happens next? Your basic rule, a company abandons the historic cost principle when the future utility, that's the revenue producing ability, of the asset drops below its original cost. Okay, so if you think about this, say you've got an inventory of those big old TV sets that were so, big and clunky. What do you think the cost of replacing that inventory, what happened to the cost of replacing that inventory once the flat screens came in? Well, the cost to replace those would have plummeted probably to close to zero. And so the rationale for the lower of cost or net realizable value is that if the replacement cost for that inventory has dropped, then chances are the selling price for those products has either already dropped or is about to drop. So, and if you think of, the tech industries, things get obsolete fast, fashion, that changes daily. And so this is why you do your, inventory at FIFO, LIFO, average cost, get that all done. Then the next step that we get into in this chapter is we compare that to the net realizable value, and whichever is the lower of those two amounts is what is going to be reported on the balance sheet. Okay, and we write down the inventory in the period when the price drops, not in the period when it is sold. Okay, so once we know the replacement costs have dropped, then we make our journal entries. Okay, so the mechanics of this are not terribly bad. You start with your inventory valued using FIFO, LIFO, or average cost, just like we did in Chapter 8. Then, once we see that we'll go through all these things and say, okay, so what's the replacement cost of this inventory? What's the net realizable value? And then we get to sort of an example of how this might work. Okay, so this is actually on the PowerPoints if you want to look at it. I alter some of these because to make more sense to me, but these are pretty much like they are on the PowerPoint. Okay, so here's a bunch of inventory. You've got your various vegetables, and this is the cost. This is the net realizable value. And so what we would do is, there's a couple of different ways to calculate it. One is on an individual items basis, which frankly most people do. The other would be on a total inventory basis. So if we're doing it on an individual item basis, we look and say, okay, the spinach cost 80, net realizable value now is 120. We pick the lower amount. The carrots, it's about the same, so not a big problem there. Your beans, the net realizable value is less, so we go with that. The peas, same deal. And the mixed vegetables also, we're going with the net realizable value because that's dropped below their cost. So our final inventory value on an individual items basis would be 384 as opposed to the cost of 415. Now let's just slide over here a little bit and see if we did this on a total inventory basis. We would simply take these two columns right here, we wouldn't bother with this. We would just say, okay, our total cost of all our items is 415, our total net realizable value is 424. And so in this case, we would be using our cost as the valuation for our inventory on the balance sheet. And you can also, if you want to look at the PowerPoints, they show how to do it by major categories of inventory. This gives you an idea of how it works. Okay, so basically, if we are using, we'll go back to the individual items basis here, and there's two different ways to record this drop in inventory because it does get recorded on your books. One's the cost of goods sold method. The difference between the two inventory valuations is 31,000. So you simply go cost of goods sold and reduce your inventory. Okay, so if we want to look across here to see this, here's your cost, your final inventory value, and the difference there, adjustment needed is 31 to get it down to that net realizable value. Okay, so doing the entry to cost of goods sold, and you can compare what happens on the income statement and balance sheet with this, but you're basically burying any of your inventory declines in the cost of goods sold. This could distort your profit margin, and basically it lacks what they call representational faithfulness, and you balance that against, is it really material enough to worry about? But the reduction in inventory value, it shows up as an increase to your cost of goods sold. So obviously to accountants, that's not the preferred method. They'd much rather see the loss method used, where you specify out, you've got the same amount of adjustment, but it's a loss due to decline in inventory and reducing the inventory. So it's a separate item on your income statement, does not distort the profit margin, and it shows the loss clearly. Okay, so here we have been crediting the inventory directly. Just to make your homework more difficult, most companies use an allowance method rather than just doing it simply to inventory. So let's take a look at what that looks like. If we're using an allowance method, and here we're just using the loss method, it would just be, instead of inventory, you have a contra account to inventory, which is allowance to reduce inventory to net realizable value. The amount would be the same, assuming it's the first year of operations. Okay, most accountants will just keep this allowance account open, and it gets adjusted from one year to the next as needed. Okay, so what I want to do is I'm going to just take a look at a few of the brief exercises, and I think they may be, kind of helpful to look at.